everybody. I am Dr.A.NAGALAXMI, Assistant Professor, Department of BCom Finance in Dr. SNS Rajalakshmi College of Arts and Science, Coimbatore, 49. Here we are going to see a case study. A case study is relating to partnership accounting. The topic of the case study is Garner versus Murray rule. So Garner versus Murray rule is a very popular and which is adopted in partnership accounting in India. First we are going to see the case Garner versus Murray. Garner, Murray and Wilkins were partners with equal capitals. The asset of the firm on dissolution after satisfying all the liabilities to creditors and advance from partners was insufficient to repay the capitals in full. There was a deficiency of rupees 635 and the capital account of Wilkins was showing a debit balance of rupees 263. Nothing could be recovered from Wilkins owing to insolvency. So this is a case. So here what they are explaining is there are three partners: Garner, Murray, Wilkins. So they were sharing the profits and losses equally. They mentioned as equal partners with unequal capitals. That is, the capital contribution of the three partners are not equal. So the assets of the firm on dissolution. So at the time of dissolution, all the assets has to be realized in order to settle the liabilities of the partnership firm. So it is compulsory to make the settlement to the creditors, bankers. Then if there is any loans or advances from partners, after paying all these things only, capitals will be satisfied. That is, capitals will be settled based upon the amount which is left as balance. But in this case, there was a deficiency of rupees 635. That means the balance is a negative balance. And another thing is, Wilkins, one of the partners, capital account is showing a debit balance. That is minus balance of 263 rupees. So, when there is a negative balance, he is said to be an insolvent person. He does not have anything to repay. Then how the capital accounts will be settled? That is the case. Decision of the case. So the decision given by the court. This case, Garner versus Murray, was taken to the court of law. The decision given is the solvent partners are only liable to make good their share of deficiency, and the remaining assets should be divided among them in proportion of their capitals. Here does not come the profit sharing ratio. Here it comes the capital ratio. So what the judgment given is, the insolvent person should not be included. Should not be included. Only the solvent partners are liable to make good their share of deficiency. That is, the deficiency, 635 rupees deficiency in the realization account is to be bared only by the solvent partners. Who are the solvent partners? Garner and Murray. Insolvent partner is Wilkins. And the remaining assets, which if anything is left, that assets has to be shared by the solvent partners only in capital ratio. This is the decision given. Now, we are going to see the effect of this case. The solvent partner should contribute to the deficiency of capital in case of their share only. See, again I am repeating. The solvent partners should contribute to the deficiency of capital in cash of their share only. That is, they should not take that amount from their capital account to settle this. Instead, they are instructed to bring cash. That is, he has to bring the deficiency amount only from outside source. That is his personal source. This is the first effect. Second effect, the net effect is that the deficiency of capital of the insolvent partners get distributed among the solvent partners in the ratio of their last agreed capitals. That means, see, 3 partners were there. Deficiency is to be borne by 3 partners. But in this case, one partner is insolvent. And his capital account is in negative. So, no way that partner can contribute to the deficiency. So, the decision given is the solvent partners has to bear the share of deficiency. So, here Garner will give his share in cash. Garner will settle his deficiency in cash. And these 2 people are liable for the share of Wilkins. So, how they will share that deficiency, other partner's deficiency? In the last agreed capitals. That is in capital ratio. In capital ratio, the deficiency of the insolvent partner, after settling the share of their deficiency, the solvent partners has to bear the deficiency of the insolvent partner in the capital ratio. This is the effect of this case. There are some criticisms of Garner versus Murray rule. See, for everything there will be a negative part and there will be a disadvantages and there will be a criticism. The same thing applies for Garner versus Murray rule. It does not apply when the firm is having only 2 partners. So there is a check. If there are more than 2 partners only, this rule can be applied. If there is 2 partners and one partner becomes insolvent, the other partner cannot bear the deficiency and cannot bear the deficiency of the insolvent partner also. So this does not apply when the firm is having only 2 partners. Next, it considers only the book capital of the partners, ignoring the private assets of the solvent partners. If a partner contributes more than capital than that of the other partners, he will have to bear more burden than other partners who has contributed less capital. The next criticism is, if a partner having 0 capital balance or debit balance will not have to bear the deficiency of the insolvent partner. See, for an example, in this, Garner, Murray, Wilkinson. Wilkinson is an insolvent partner. And he is also having debit balance, that is negative balance. So, he cannot bear the deficiency. Example, one more partner is there. For example, if there is 4 partners, one becomes insolvent and the other is not an insolvent. Among the remaining 3, other is not an insolvent, but he is having the negative balance in his capital account. That is debit balance in his capital account. He is not supposed or insisted to bear the deficiency of the insolvent partner. The next one is introduction of cash by the solvent partners to make good their share of loss on realization is unnecessary when the balance of capital accounts of the solvent partners are sufficient to bear the deficiency of insolvent partner. Make it clear. If the solvent partners, see what I explained you previously earlier, that the solvent partners has to bear the deficiency of their own by introducing the cash to the partnership. Okay, and they are supposed to bear the deficiency of the insolvent partner. In that case, if the capital balance of the solvent partners are sufficient, then from that capital balance they can contribute the deficiency of the insolvent person based upon their capital ratio to the partnership firm. These are all the criticisms of Garner versus Murray rule. Applicability of Garner versus Murray rule in India. So here, this is not a case of India, but it is a case of a alien country. But that rule is applicable in India. The rule is adopted. Section 48 of Indian Partnership Act 1932 is similar to the Section 44 of Partnership Act in General Britain. And further, there has been no case law in India to deal with such situations. So in India, this is applicable with respect to the following considerations. As India was ruled by British people and Indian law is enacted by keeping the British law as a base. Here the Garner versus Murray rule was a rule which is in Partnership Act of Great Britain under Section 44. The same thing is taken as an example and it is adopted in Indian law as Section 48 of Indian Partnership Act 1932 with some considerations. We can see what are those considerations. Garner versus Murray rule is applicable only when there is no agreement between the partners for sharing the deficiency in capital account of insolvent partner. See, there is a partnership deed. It is compulsory for a partnership firm. If nothing is mentioned in the deed about the sharing of deficiency of an insolvent partner in future, then this rule can be adopted. First one. Second one, realization loss should be divided in profit sharing ratio in the usual manner. Normally, realization account will be prepared. Realization account will be prepared in insolvent, that is dissolution of the firm. So, in preparation of realization account, the result will be either profit or a loss. If it is a loss, it should be divided among the partners in profit sharing ratio. The solvent partner should bring in cash to make the loss on realization. So, if there is a deficiency, if there is a loss, that loss of that partner has to be brought in as a cash by the solvent partners. Final debit balance of insolvent partner should be distributed among the solvent partners in proportion in the last agreed capital. So, if there is an insolvent partner, that partner's debit balance has to be distributed. That is, it should be given, it should be settled by the solvent partners in the capital ratio. The last is a solvent partner having debit balance in capital account will not share any loss due to insolvency of a partner. See, as I said earlier, if a solvent partner is having a debit balance, that is, if he is having a negative balance, he is also not instructed or supposed to share the deficiency of the insolvent partner. Conclusion. To conclude, it can be said that it is not unjust and inequitable law to ask a partner with larger capital to bear the large portion of the loss. Psychologically, the partners with a lesser capital will not react unfavorably. That is, we cannot say we are showing the partiality to the solvent partner, and if he is having a sufficient balance in her capital account to bear the loss of the larger loss of the insolvent person, or the solvent or the share of the insolvent partner. But if a solvent partner who is having negative balance are not supposed to take part in the share, but the solvent partners with high sufficient balance are supposed. So we cannot say it is an injustice or inequitable law. But someone has to bear. That lies on the hands of those partners. Thank you. Thank you so much for your patience listening.